Again, everyone, thank you again. This is our 6th in the series, post-webinar or post-summit webinar series. Allianz Life is presenting Help Your Clients' Grandchildren Get a Strong Start. Nate Lund is Allianz's senior internal wholesaler in the life division. He handles the Central region, and he handles Insurance Network America, our marketing organization for Allianz Life. So, Nate, I'm just going to let you take it away, and it's all yours.
Sounds good, Mike. Thank you. Good morning, everyone. I appreciate you being here. What we're going to talk a little bit about today is, as Mike said, a way to help your clients, specifically the ones that are in the senior market. So for those of you working with an older clientele, or maybe work primarily in the annuity space, where that's going to be the case, your 50s, your 60s, 70s, we're going to talk about what opportunities do you have for them to set up some kind of a legacy for their grandchildren. So before we get started on that, just a quick housekeeping item here. This presentation isn't designed to offer any legal or tax advice, although we'll be talking a little bit about some legal and tax topics. And although I think I know a fair amount, I'm not the foremost authority on all the legal ramifications or tax information out there in this space. But we do have an advanced markets head named Deb Repia, who we have available to us here at Allianz, who does know quite extensively the ins and outs of trust information, tax information, gift tax, estate tax. So, as you're thinking of questions as we're going through this, feel free to type them in the box there. I will try to get to them to the best of my ability, but know that a lot of these questions can be very specific or depend on circumstances and then state. So for some of those, feel free to give me a call after the presentation, or Insurance Network, and we can connect you with Deb here at Allianz and get some of those sticky questions answered. So, and my number is 763-765-6674, and I'll give that to you again at the end here. But I just wanted to touch on that here as we're going through. So love to hear the questions. Just know that if we don't get to them today, because they're very specific to your situation, we can certainly get to those later. To begin with, we're going to take a look at life insurance in here and how it can be the ultimate gift for a grandchild, both in the way of not only death benefit protection, but also the cash accumulation that's unique to life insurance. Number two, we're going to take a look at how to properly structure these plans. There's a lot of mistakes that can be made in setting these plans up when it comes to taxation, both estate and gift, and we want to make sure that we're designing these to give your clients the best benefit possible. And then we're going to take a look at some specific case studies and sales ideas that you can take out to your clients and actually start using today. So as we're going through that third section, take notes of who might fit these descriptions that we're talking about and who you can go and visit with following today's presentation. Taking a look at your clients and thinking about which ones have grandchildren and who could benefit from a plan like this, and who are looking for opportunities to gift money to their grandkids. Now, if we take a look at college costs, and where they've been and what direction they're going, one thing we can most certainly agree on is that they are skyrocketing. If you look back, you can see some of the stats here, college degrees costing anywhere from $52,000 to $130,000 today, and those costs are increasing faster than inflation. In fact, if you took a look back over any 17-year period between 1958 and 2001, you'd see anywhere from a 6% to a 9% college cost inflation, it typically doubling the general inflation rate. What that means is that if you had a child who was born today, the cost at roughly 8% inflation is going to be 3 times more expensive when they actually enroll in school. So, for those of you looking at, let's just say you had somebody who wanted to go to a private college. Maybe that school costs $30,000 today. Not uncommon at all. If we took a look at where's that college cost going to be in the year 2030, and let's just assume a 7% inflation rate, we can anticipate that child needing over $100,000 a year to go to school. That being said, It's no wonder that with younger families today, I'm in that group. I just had a child myself thinking about, hey, what am I going to do in 18 years if I want my child to go to my alma mater? Who's going to pay for that? And where some of those funds going to come from? It's one of our most important financial goals. So how can you help your clients get there, and how can the grandparents be a big part of giving those kids that strong start? First of all, when you look at life insurance, obviously number one, it does provide a death benefit. Whether that death benefit is coming from the life of grandma or grandpa, or whether or not that death benefit is there to protect in case something were to happen to their parents over the course of the next 18, 15, 10 years, however long we have till school starts, something happens, we have a self-fulfilling plan here that's going to pay out a death benefit to eventually help pay for those college costs. But something unique here that we're going to look at is, what about the cash value accumulation that's also building inside of, in this case, an FIUL product? And what unique tax advantages do we have to accessing that policy as well? Not only with an FIUL do you have the income tax-free death benefit as you do with any other life plan, but we also have the tax-deferred accumulation inside the policy, which means over time, just like any other tax-deferred vehicle, we're able to build more money over a longer period of time. Now with life insurance, we also have the unique ability to access those funds at any time that there's cash value, income tax-free via policy loans, which is really the way that we design our policies, whether it's for supplemental retirement or for business planning, or in this case for college planning. Down the road, being able to access your cash value, income tax-free, to help pay for school either in total or just a portion of. But what's nice with life insurance is the flexibility as well. You're not locked into this as strictly a college funding plan. What if the kid doesn't go to school? What if they're a star athlete or excel in the classroom and their school is entirely paid for? They don't need these funds to help them pay for that cost. Now you have a plan that can be used for something entirely different. Maybe it's for the parents for retirement, or maybe it's to help that grandchild with the purchase of a new home years later. You have those different options. And not only the flexibility in access, but also the flexibility in how we're structuring this policy and how we're going to pay for it. So when we're setting these up, you're not locked into a specific premium amount for a specific period of time. You have the option to increase or decrease those premiums depending upon your need and how we establish the policy on the front end. And the other nice piece to life insurance here as it pertains to college is we don't have the college funding eligibility requirements. So the potential for funding all or a portion of your college education with life insurance means that you don't have the complex eligibility requirements, no qualified education costs, and no income limits. And typically, and again, this can depend on schools and states, but the policy loans don't affect the student's eligibility for other forms of financial aid. So there's a lot of unique advantages that the FIUL product is going to be able to provide when it comes to college funding, both in the way of death benefit and cash value. But beyond just the product itself, it's important that we structure the policy properly, which means we got to look at considerations like who's owning the policy, who's the insured, and who's the beneficiary, and why does it matter which one is in which place, and how does that what tax implications are there for each one of those designs. So what I want to do is take a look at a few different generational planning strategies that we could look at, because obviously there are many that you could set up. The first of which we want to just take a look here. We're going to say we have a grandmother, Sally, and we're going to say the parent here, her daughter is Lisa, and Sally's grandchild is Henry. Now, in these cases, we're also, assuming that Henry obviously is a minor, and typically minors do not have the legal capacity to take a death benefit outright should something happen. So, in some of these cases, we're going to look at to resolve that issue. We need to consider setting up trusts to distribute these funds down the road to someone who's a minor should something happen before the child goes to school. Now, in strategy number one that we're going to look at, we're going to say that Sally, the grandparent here, and again, as we're going through these, please think of some clients you have that might be a fit and fit the parameters here of having a grandchild who is say under 5 years old, or in some cases we can work with situations where we have less time, but typically we do need more time. So think of your clients that have younger grandchildren. In this case, we're going to say Sally, the grandparent, is wanting to gift premium to her daughter Lisa, the parent, to purchase life insurance on Lisa's life. So in this situation, we have Sally gifting the premium. She's sending that over to Lisa, and now Lisa is going to take that gift and buy her own life insurance policy, meaning that Lisa is the owner and insured on her policy. And in this case, we're going to assume that you're also setting up a trust here for Henry for the benefit if something were to happen to Lisa. That trust would then take on those death benefit proceeds and could distribute those to Henry as Lisa intended, or perhaps even as Sally wished. Obviously there's a good relationship here between Sally and Lisa, because really Sally is just passing those funds on. She does not have control of this policy. She's relinquishing that all over to Lisa, her daughter. So what are some of the tax implications of this first design? Number one, for Sally, the grandparent, she's going to be gifting that premium to Lisa, and currently the annual exclusion amount is $13,000 per year to avoid federal gift tax. And in 2012 here, rolling over from 2011, she also has that federal gift tax exemption on her lifetime of $5.12 million. Now that's expected to change next year in 2013. To what degree $1 million is what they're anticipating, and as you go down the road of gifting more than that $13,000 annual amount, that's going to cut into their overall lifetime exclusion and potential clawbacks down the road. But again, we don't know for sure what that's going to look like. Now, state gift taxes may apply in some cases. Again, that's why I mentioned we have to take a look on a case-by-case basis, but no income tax deduction for Sally. So really, let's just assume she's gifting up to that $13,000, and that's all a free gift that she can give away to Lisa. Now, from Lisa's standpoint, the parent, she has no income tax on that premium gift and no federal gift taxes. So she's able to just receive that $13,000 outright and purchase her life insurance policy for the benefit of Henry here. And obviously that death benefit that's established is going to the trust, who is going to proceed to pay those benefits out to Henry down the road. Now, looking at another design that we can set up. In this case, we're going to say that Sally wants to keep control of the policy. Typically, in this kind of a case, she would be just purchasing the policy on herself and owning the policy herself. Obviously, we have to consider that Sally is insurable. Typically, this works best if you have a younger grandparent, maybe somebody in their 40s or 50s. So young grandchild, young grandparent, costs for the insurance are not too high to accumulate cash value. This can be a plan that works. Now, in this situation, we're going to say, again, Sally is purchasing her own life insurance policy, and she's going to set up a trust for the benefit of Henry. Now, you could also look at a Uniform Transfers to Minor Act, an UTMA or an UGMA, depending on the state, can also be listed as the beneficiary in lieu of the trust. However, the downside to that is that the grandchildren would just receive the money outright at 18, meaning there's less control in there for Sally. So if she has specific, distribution intentions for that death benefit, when something happens to her for Henry, she'd want to set up a trust that she can lay out the language in as to how Henry is going to receive that money. Now, what are the tax results of setting it up this way? Now, for Sally, she's not gifting the money to anyone. She's simply buying a life insurance policy at Allianz, so there's no, obviously no gift tax, no income tax deduction. She's simply spending the money on her own life insurance policy. Now, that death benefit, since Sally owns it, will still be included in her taxable estate. Again, currently $5.12 million in that estate tax exemption, likely to change. And then in this case, the grandchild or the trust is going to receive that death benefit income tax free. So in this case, you don't have that, you're not gifting the money out, we're just assuming that the grandparent is purchasing that money and keeping it all in her estate. Now, the third way we could look at this, instead of having Sally purchase the policy on herself and owning it, she wants to get it out of her estate. So the third way we could do this is to list a trust an ILIT, in this case an irrevocable life insurance trust, as the owner and beneficiary of the policy. So what Sally does in this case is she goes ahead and gifts premium instead of to her daughter to this ILIT. So she sets up on that ILIT all the language of what's going to be in there, so this FIUL product and how it's going to be distributed to the beneficiary. So she sets that up on the front end. Downside is she loses control. It's no longer in her estate. She's gifted that money away to the ILIT. The ILIT now controls the policy. It's out of Sally's trust and out of her control, or out of her estate and out of her control. Now, in this case, Sally could be the insured, or if she's not as healthy, or maybe it just makes more sense for Lisa to be the insured because she's maybe she's 30 years old and in great health. We have lower cost of insurance to put the policy on her. Now, in this case, benefit is still that ILIT, and that's going to pay out the funds to probably Henry down the road again for college or whatever Sally sets up on the front end. But what are the tax results of looking at having the trust own and be the beneficiary? In this case, again, just like strategy number one, Sally's taking advantage of gifting those premiums out to the ILIT in this case. So she still has that annual exclusion of $13,000 a year, overall federal gift tax exemption of the $5.1 million, and then on the beneficiary side, death benefit still remains tax-free. Now, the three different situations that we've looked at have been involving two different parties. They've had two people be involved in the three-person process of the owner, the beneficiary, and the insured. There's something called the Goodman rule out there, and this is a common misstep that we hear with agents when setting up these policies. Typically, what we're looking at is a situation where they'd want the grandparent to own the policy. They'd want the insured to be the parent, so Sally owns it, Lisa's the insured, and Henry is the beneficiary. And the problem here is that when you set this up, the Goodman rule is what it's called, applies. And if the owner is the grandparent, the insured is the parent, and the beneficiary is the grandchild, when the insured were to die, the death benefit would then be a taxable gift from the owner, in this case the grandparent, to the beneficiary, who's the grandchild, and gift taxes would apply. So again, a common mistake that we see being made when trying to set these up, and that's why when we look at the different strategies, we try to set that up with only two parties being involved for the three positions that are here, the owner, the insured, and the beneficiary. Again, give us a call, and that's why that's something we can help you set up and make sure that you're establishing these in the most tax-efficient way. Now, what are some sales ideas that you can, again, start implementing here and using to help build your business and build revenue? If we take a look at a hypothetical example, let's just go back to the strategies that we've been talking about and assume that Sally here is wanting to gift premium to her daughter, Lisa. In this case, we're going to say that she's going to give Lisa $300 a month. Lisa is 30 years old and in great shape. Son Henry is 3 years old. And in this case, we're going to set up a trust for Henry as the beneficiary. Now, what's that going to look like with our Life Pro Plus product? In this case, we have the $300 a month going in. We're going to assume a minimum death benefit for Lisa. In this case, it's going to come out to about $175,000. Again, death benefit that's there should anything happen to Lisa in the short term. In this case, we're going to assume that the fund grows at 8% per year as an average illustrated rate. And if we take a look 15 years down the road, when Henry is about to begin college, we're going to have a projected cash value of about $78,000, which would give us roughly $20,000 per year for 4 years of school. So in this case, Grandma's been able to essentially give her daughter $300 a month for the benefit of Henry, so that down the road, Henry's able to essentially get about $80,000 to help pay for school, which obviously we talked about is going to be much more expensive. Now, another way that you could set this up, and it's not going to be shown here, but another way to set this up, especially if we have a shorter time period to work with, so a little bit older child, instead of setting these up where we start pulling funds out at age 18 for the student, what we can look at is having the student taking out interest-free student loans to help pay for school. And once the student is about to graduate, before that interest really starts to kick in, then at that point the owner can go in this case Lisa, go in and pull out a lump sum loan to help pay back from her life policy to help pay back those student loans on the back end. The reason that you might want to do this is it gives you 4 more years essentially of accumulation and funding potential that's only going to help build the policy cash value even greater over that time period. So another way to look at it when it comes to case design and how we can structure these policies with the highest cash value benefit. Now, taking a look at another way that you could set this up, in this case, Sally's husband, Dave, is the healthier of the two. He's the grandfather, and we're going to assume that he's going to buy a life insurance policy on himself, again, for a 3-year-old, in this case, granddaughter named Madison. Now, in this scenario, like I said, we want to make sure that Dave is in good health. He's relatively young, so from a cost standpoint, this can still work out well. And in this case, we're going to say we're setting up, again, a trust for Madison in the event that something else should happen. So taking a look at some of the projections here, we're assuming that Dave is a 55-year-old, standard non-tobacco, and based on him giving an annual premium of $10,000 a year, again, underneath our $13,000 annual exclusion, he's going to give in $10,000 a year. We're going to minimize that death benefit to really maximize his cash value. In this case, he'll have a death benefit there at the top of about $150,000. We'll again assume an 8% illustrated rate of return. And at age 71, or 16 years down the road, he's got about $256,000 in projected cash value, which would amount to about $70,000 a year for 4 years of school for his granddaughter, Madison. So again, what has he really done here? He's basically paid in that $10,000 over 16 years, so he's contributed about $160K into his life policy, having a death benefit set up in case something should happen to him in the short term, but then able to essentially pull out about $280,000 to help pay for Madison's school. So he's really been able to not only give a death benefit, but also provide a great legacy for his granddaughter to help her pay for those high rising costs of college tuition. So again, just to recap, we look at what can life insurance really do, and how are your grandparents going to be a good fit for that. They can really provide a great legacy here for their grandkids in the way of cash value accumulation and in the way of life insurance death benefit, which continues to carry on even beyond the child going to school. There's still going to be that death benefit there that you can leave behind to their grandkids tax-free. It's also important that we look at how we structure these policies and avoiding some of those pitfalls in terms of taxation, gift tax, and estate tax. What's the best way to set those up? Certainly give us a call, give Insurance Network a call, and we can help you structure these. And lastly, looking at the case studies, who is in your book of business currently that maybe you've worked with just on the annuity side or just on their own personal retirement accumulation that are now looking for ways to help the younger generation out. What can we offer them here? And like I said, I think you saw in this presentation, FIUL can be a great way to do that. We also at Allianz and on our case design team here have several different resources available to you to help you implement some of these sales ideas into your business. Beyond giving us a call and helping us or letting us help you structure some of these plans and case designs, we have an outstanding marketing kit called Help Fund College with life insurance. That kit's got several consumer and agent-approved pieces that are guides for you on how to set these plans up, and also for your clients some great consumer-approved pieces on fixed index universal life. How does it work? How does cash value accumulation inside these plans work? And what are some of the tax benefits when it comes to distributions coming out of these plans? And one piece in there specifically is that grandparent brochure. We have a piece directly marketed toward these grandparents that you can order and mail out, or send in PDF format if you prefer to email, that's directly aimed at grandparents and how they can create a legacy for their grandchild. We also have a great piece on how to structure a life policy. So it gives you a little bit more detail on the different ways that we could establish this. Who's the owner? Who's the insured? Who's the beneficiary? And what are the gift and estate tax implications of different scenarios? Which ones does Allianz prefer to see? And what are some underwriting considerations, both health and financially, that we need to consider as well? And we also have a great new sales concept software that's tied to our life insurance software just for product. This software lets you go in and plug in information about your clients, specific to how old is their grandchild, what financial plans are already in place, 529s or other assets that you've established on the front end already, and what value do we see in future student aid or student loans that they may take out. Maybe we want to plan on the student taking 50% out on their own end to pay for school, and we want to cover the other half. How do we fill that gap, and how can life insurance play a role there? So it lets you set yourself apart from other agents and become somebody who is going to present a solution to a funding gap that's going to be out there for these rising costs of college. How do you fill that gap with life insurance as opposed to just pushing another product? So great software. Give us a call. We can show you how it works and, like I said, how you can really set yourself apart in the industry. We also have an event coming up here next week. We have a new rider rolling out that I think is going to be very relevant to this same topic. It's a rider for our Life Pro Plus product called the Premium Deposit Fund Rider. We have a webinar coming up next Thursday, October 11th at 2 o'clock Central Time. And really, we're going to go through this rider in depth at that point, but really what the rider does is it allows you to collect from in this case, let's assume, stay on topic here, assume you're collecting from one of these grandparents. Maybe they don't want to go through the process of giving you $300 a month or $10,000 a year. Maybe they just have $100,000 that they'd like to gift to their son or daughter or to a trust to set up one of these plans. Well, what are you going to do with the single premium? We want to keep these life insurance policies as non-MEX to keep that cash value tax status favorable so we can get after it income tax-free down the road. What can you do with a single premium? This rider will take that single premium and essentially distribute it into the life policy over a specific period of time, 5, 6, 7, 10 years, so that we can max fund the policy in a simple manner that's all automated, so you as the agent don't have to go back and collect these premiums every single year. It's all going to be set up on the front end. So again, a simple, predictable way to set these policies up for your clients. So log in next Thursday, October 11th at 2 o'clock Central Time. If you want more information or don't have the registration link, be sure to check the blue newsletter that you may receive from Allianz every Tuesday. Check your archive there, and if you don't have it, you can certainly give me your insurance network a call, and we can get you another copy of that information. At this point, if you do have any questions, feel free to type those in. Again, I'll do my best to answer them, but if they are specific to a case you're working on or tax or legal information that you have on trusts or gift taxing, you can always give me a call offline as well, and we can certainly talk to our advanced markets team and get you an answer that way as well.
Okay, well, Nate, I've got one from Kyle. It says, how to lock in for Henry to block Lisa from being a scofflaw?
In terms, I don't know. That one might be one where, give me a call after. We can talk to Deb about it. Obviously, there can be some tricky go-arounds there in terms of structuring those, and to be honest, I don't know if I'm familiar enough to give you some advice on that. So certainly give me or call Mike thereafter, and we can connect with Deb in Advanced Markets and get you an answer on that one.
Well, give Kyle your number again just in case.
Yep.
He didn't
Yep. My direct line here is 763-765-6674. And yeah, Kyle, give me a call on that, and we'll get you an answer.
Okay, and then another question, this is from Kyle again. Do you have sample letters as models that we can mail to clients soliciting business for this concept?
Absolutely. Yep, we have several different sample letters that we've written that you can, I guess, you use exactly how we've done it or use it as a template to design your own. But yes, we do have those available in that college funding kit, as well as some other pieces that you could tweak to, to go along with the same story.
And Kyle, you can go right to the website and pick that up, or if you need help with that, you can call us and you can speak to Mike Mallon directly. And he'll be able to direct you as well. Or you can actually, when you're talking to Nate, he can walk you through it as well.
Absolutely.
Kyle just had it was a question question, 7-pay plan, and so that's all it said in the question, so I just want to make sure maybe you could expand on that a little bit, Nate.
Sure. 7-pay plan, I mean, he may be referring to, how we're max funding these, whether or not we're paying some of those premiums in over a 5-year, 7-year, 10-year period of time. There are different ways we could structure this so that we're max funding it, to that MEC limit on that death benefit over any given period of time. So,
and that would be a MEC. That would be just staying underneath the MEC limit and he just typed in for compliance. So the completion was 7-pay plan staying inside of compliance, and you want to be able to do that premium standpoint so that it doesn't MEC out and become a taxable event, right?
Exactly. So when we design these cases, we'll fund them to the maximum that the IRS will allow to keep them in that non-MEC status. And again, another way that premium deposit fund rider I'd mentioned at the end there works is to essentially distribute a lump sum into this life policy over a set period of time to avoid creating that MEC as well.
And a question I had for you, and I had to step out, so you probably discussed this, was we're looking. This generally works more in the high net worth model. Generally works with clients who have some significant assets that they're not going to leverage or use, and they need to transition those. They're basically what I call transitioning pennies for dollars, tax free.
Exactly right.
Did you talk about grandparents who are maybe at their RMD level on their 401k or IRA, where they're using those as annual gifting and then dropping those into a trust for the kids' education on a life insurance? I guess the question becomes, did you go over all the different scenarios of where the money can come from?
I didn't go over all the different scenarios, but yeah, RMDs are certainly one that we hear about. If you have these higher net worth clients that maybe they don't need these funds that they're being forced to take out. Obviously, they're a little bit older, so you may run into how old is the child, because in some cases, if we're doing it for college funding, not that that's the only reason you would gift, but if it's for that, we just simply need time on our side. And typically, if we have a child who is maybe 10 or older, it gets a little more difficult to do. I never like to say that it's not possible, but typically time is one of the most important factors to making these work. So absolutely different sources there like RMDs. Again, maybe they're just higher net worth individuals and are trying to gift funds, from a gift or an estate tax purpose. So yeah, there are several different ways that we can do that.
Okay, that sounds great. Nate, give me the 3 reasons why the individuals on this call should look to Allianz first when they're looking at this type of planning.
Sure. If we're looking from a product standpoint, a couple different reasons. The first 2 are income accumulation upside. When you look at Allianz and our life insurance product, our Index Universal Life, we have higher income or higher cash accumulation upside than anybody else you're going to see out there. When you look at our allocation choices, right now we have our most popular index is a blended index with a 17% annual point-to-point cap. And you're not going to see that anywhere else out there in the industry, and that's not in any way any kind of a teaser rate. We've had that out there for over 3 years. So again, from an upside standpoint, we're going to be able to capture more index potential than other carriers. And number 2, we talked a lot about, the whole point of this, or one of the main points, is to pull cash value out for college. Well, when you pull a policy loan out, which is the way we get it tax-free, that comes at a certain charge. Now with Allianz, we offer what's called a fixed participating loan rate, meaning that you're going to borrow a loan out at a guaranteed fixed rate. In our case, it's 5.3%. You borrow that loan out at 5.3, it continues to participate in the index with the rest of your cash value. So we're leveraging that positive arbitrage, saying that we're going to borrow at 5.3, and on average, we're going to return 7.3. Now, the difference with our competitors is that when they borrow those loans out, it's on a variable rate. So we don't, although it may be 5% today, you don't know what it's going to be in 15 or 18 years. But if it goes from the historic lows that we're at today back to any kind of historical average, you might be in a scenario where the loan rate is now 6, 7+%. Now that arbitrage you're trying to leverage there is diminished or gone. So from an upside standpoint and from a loan standpoint, we have a significant competitive advantage over other carriers that are in the industry. And from a design standpoint and a resource standpoint, we have some of the best marketing materials to help you market this concept, and we have some of the best individuals in terms of Deb Reppy and our advanced markets teams and helping you to structure these plans and essentially building this into your business as almost a turnkey process.
Okay, that sounds great. I think we got one more just came in. Don't forget that after college loans, policy converts to tax-free retirement. Okay, so yeah. So
absolutely. You know, I didn't want to skip over that by any means, but you know, you look at the case we ran there for the 30-year-old. She's funding this, or the grandparent is helping her fund this for the next 15 years. The child goes to school. Who's to say that at that point, when Lisa is in her late 40s, early 50s, she doesn't pick the tab up and start funding premium back in until she retires? Absolutely, she can start taking out her own tax-free retirement income at that point. So again, it goes back to the bullet point of flexibility. There's so many options and so many ways that you can structure this and take advantage of that cash accumulation beyond just the initial plan of college funding. Now you have a retirement plan as well.
Okay. Well, you know what? We're at about 40 minutes. I think I've got all the questions asked and answered. Nate, I want to thank you so much for being available to make this presentation. And again, thank everybody on the line for your business and hopefully potential business. If there are any questions afterwards, obviously you can reach out to us at 800-456-7999. Is there anything specific you want to ask Nate about? Nate, give me your number one more time.
Yeah, thank you. It's 763-765-6674. And thank you again to Insurance Network for having me, and look forward to speaking with you guys.
Appreciate your time. Thank you, everybody, and we appreciate your business. This is going to conclude this webinar, and hopefully you'll be on the webinars that are coming up next week. Take care, everybody. Thanks. Bye.